Hi everybody, welcome back to another video. Recently, during the announcement by the government for the budget of 2024, they have made one huge change. Other than just increasing the CPF contribution rates, the government have removed SA accounts for 55 years old and above. This change might affect a small group of people who have large amount of CPF that still want to earn that risk-free interest rate of 4%. The bright side is that OA will still be around but will earn way lesser at 2.5%. Now, what companies will easily benefit from all the withdrawals the most? That will be the Singapore banks, funds and financial service companies. Why? Because with people withdrawing from CPF, they will have to be able to put it somewhere, which will be these places. In my opinion, banks will definitely benefit the most as they will be considered the best safe options. This brings about opportunity for our three Singapore banks, which is OCBC, DBS and UOB. Although the share prices has risen quite a bit during the recent years, they are still giving quite an attractive yield. So in this video, we'll do a quick analysis on the three respective banks and the good and bad factors that will affect the bank's performances. First, let us look at DBS performances. For the full year of 2023, it has been an amazing performance for all banks. For DBS, it has hit record profit of 10.3 billion with the return of equity at 18%. So for those who are not familiar with ROE, return on equity is a gauge of a corporate's profitability and how efficient it generates those profits. For DBS, it's at a record high, which justifies the efficiency in how they generate these profits. The cost to income ratio is at a healthy level of 39%, allowance coverage at 128% and 226% after considering collateral, and the CET1 ratio is at 14.6%. So this ratio is very important because it is the safety net for banks. The higher it is, the better. However, it's important for banks to strike a balance between keeping how much cash, because keeping too much will be considered too conservative and losing out on opportunities or rewarding shareholders. Similar to last financial year, with their performance being so good, they have actually rose their dividend to 54 cents per share and a 1-for-10 bonus issue proposed. Moreover, they have also said that going forward, the dividends are expected to stay at 54 cents even with the enlarged share base. So this is a very good thing if you are a shareholder that looks forward to quarterly dividends, as 54 cents will equate to about 6.5% at the current share price. So if we include the 1-for-10 bonus issued, that will equate to about a dividend yield of 7.5%. With the interest rate stabilizing, their net interest margin has stabilized as well. This value is very important because it's the profitability that they earn from the interest. However, the bright side is that their non-interest income has still been performing well. As you can see from the Q3 to Q4, it's still a slight increase, and that is very decent. The one thing I would like to focus on the next few quarters will be their CASA, and that is the cash savings accounts. With the changes in CPF next year, we will expect people who are 55 years old and above to start withdrawing this amount of cash and putting in the Singapore banks. Additional positive pointers can be taken from their earnings call transcript as well. With the help of digital transformation throughout the years, they have actually improved their ROE businesses in secondary businesses such as the treasury market and transaction banking, from single-digit ROE to double digits. And that's a huge improvement, with ROE for this year expected to be in the north of 17% and maintaining at 15% on sustainable basis. DBS still has a lot of capital, and that is good even after giving such a huge distribution. So I expect in the next few quarters they will continue to do well and give sustainable dividend at these levels. I hope that you have enjoyed the video so far. Please support the channel by hitting the like, subscribe and comment on what you feel about the recent bank environment as well. Thank you, and let's continue with the video. Next, let's talk about OCBC. Although they have declared a higher dividend, the share price has actually dropped by about 3% when it was first announced. In my opinion, there might be a few reasons. The first reason might be that because the dividend did not increase as much as what investors hoped for. Second is because the non-interest income has dropped quarter over quarter by 17%, even though the year over year shows 25% increase. Q over Q of total income dropped by 5% is not that bad, similar to DBS, which also encountered a similar drop in quarter over quarter results. OCBC is known to be the most conservative bank out of the three. That can be good and bad. Conservative would make them more stable during difficult times. If you can see, their CET1 is at 15.9%, and that is way higher than DBS at 14.6%. Moreover, their dividend payout ratio is at 53%, which gives them 47% of their income for growth or for emergency cases. So if you see the non-interest income, the reason for the drop is because of the dip for the life and general insurance, while the rest is still the same at decent levels. However, their ROE is not as high as DBS at 13.7%. This shows how efficient DBS is as compared to OCBC. For OCBC, one of the main reasons why their ROE might be lower is due to the larger exposure to Greater China. However, in my opinion, in the long run, OCBC will still continue to do well, similar to the past few years. Next, let's take a look at UOB's results. UOB Bank is actually an opposite of OCBC, where they are considered the more aggressive bank. For the full year of 2023, their ROE came in at 14.2%, which is slightly higher than OCBC but still lower than DBS. They have a slightly higher cost-to-income ratio for the full year of 2023 at 41.5% as compared to OCBC and DBS. Their CET1 ratio is also lower at 13.4%. What I like about UOB's result is that if you see for their Q4 of 2023 and Q3 of 2023, the net interest and net fee has just dropped slightly by 1% and 4% respectively. Their non-interest income had not declined at all. This allows their net profit to come in slightly higher at 2% as compared to DBS and OCBC, which had a slight decline. With their dividends at 85 cents, the payout ratio is only at 50%, allowing them to keep the other 50% of the income. Even though UOB is considered the more aggressive bank, if you see their balance sheet, it's still much safer as compared to overseas banks. So if you look at this summary between the three banks, for dividend yields, OCBC actually comes in higher at 6.5% based on the current share price. For DBS, it's at 6.4% for the new dividend of 54 cents. However, if you include the special bonus of 1 for 10, the dividend yield will be at a high of 7.5%. That's very good for banks. UOB comes in at 6.1%. And if you see their payout ratio, DBS is higher at 55%, while UOB is at the lower end of 50%. For ROE, DBS comes in the highest at 18%, showing how efficient they are in using the funds. This is one of the main reasons why they are priced at a higher premium, as their price to book ratio is at a higher level of 1.36, whereas UOB and OCBC is only at 1.02 and 1.12 times. So with all this good news, is there negative impacts that will hit the banks in the next year? Definitely there will be risks involved. Firstly is lowering of interest rate, which will definitely bring down their net interest margins and therefore their net interest income. Secondly, recession. Although it's a small probability, but that might still happen in certain countries. So we'll see if there's any recession which will definitely affect banks. There are also factors that will actually benefit banks as well. Firstly is the CPF change. Like I said at the start of the video, more money withdrawals would mean that banks will have more opportunities to have them being deposited into the saving accounts and kept with them. This will allow them to give out more loans, earning more income. Second is the increase in M2 money supply. With higher M2 money supply means that there are more cash circulating in the economy. This will allow banks to have more cash as well. Lastly is the constant rising housing prices in condo and resale flats. This will definitely benefit the banks with more people taking more loans. The only risk is that if recession actually comes to Singapore, people might not be able to pay for the loans and they will have to default. This will definitely impact the banks. However, if people do not lose their job and continue earning decent income, people should still be able to pay the high mortgage rates, and thus benefiting the banks. Of course, all these are just my opinions. Please do your due diligence when it comes to investing your hard-earned money. Thank you so much for watching. Please support the channel by hitting the like, subscribe and comment on what you feel about the banks. You can also watch my previous video where I talk about investing in REITs for dividends as another option. Thank you so much for watching. I'll see you in the next video.